Last September, we showed you how Australia's gold miners were cashing in, and that was when gold was at $3,600 an ounce. It's jumped much higher since then. Our colleague Paul Allen saw firsthand how miners are now putting that cash to work.
In the Australian outback, scrub and red dust stretch as far as the eye can see. It's desolate out here and it's dry. But beneath the dust, there's a bounty that miners are willing to dig a long way for.
How many ounces of gold would be in a typical truck?
So there'd be around 500 grams of gold in a truck.
So we've got a line of trucks slowly making their way out of the pit here. How long does it take to get from the bottom to the top?
Yeah, it's well over an hour.
The Kalgoorlie Super Pit in Western Australia is a sight to behold. More than 600 metres deep, it would cover even Manhattan's tallest skyscrapers. It's so vast, it'd swallow Central Park.
This project's going to be an important one for our business and our shareholders. It's over half.
Stuart Tonkin is CEO of Northern Star, Australia's biggest gold miner.
Probably around $300 to $400 million per annum being spent moving material from the southern part of this pit, gaining access to over 6 million ounces of gold in the bottom of this southern part of this pit.
The price of gold has been on a tear. Tonkin's company and many others around Kalgoorlie are cashing in. But the gold industry has been here before.
There's probably more failure stories than success stories where people can point to in the gold sector. And so repairing a lot of that trust with investors as we go into another cycle has been really important for our company, and I think for many Australian companies to get that investor trust.
Two of the dominant players in Australian gold mining, Northern Star and Evolution, are reaping the rewards, seeing the return on investment from projects planned years ago now surging. Laurie Conway is CEO of Evolution Mining.
So back in June 23, we made the decision to invest $250 million building this plant expansion and $75 million to open up a new mining centre into the north here to feed the plant, taking it from 2 million tonnes to 4.2 million tonnes. And in 23, it was pretty difficult. The market was hot. It was hard to get people, hard to get equipment. I think we were very fortunate when we did that. But, you know, gold price was only $2,400, $2,500 an ounce when the board approved this, and it had very good economics. I mean, bringing it in right now at $5,000, $5,200 an ounce is a perfect time to be commissioning it.
In 2019, Evolution reported adjusted gross profit of about $270 million US, or about 410 million Australian dollars. That now jumped to about 1 billion. It's expected to grow even further to almost 2 billion.
And how are you about on the costs front? What's that like at the moment? Because, you know, I imagine your diesel bill must be pretty high.
Yeah, diesel's only about 4% of our costs. Power will go up because we're obviously doubling the processing, and the processing uses power. 50% of our costs are labour.
And investors are keeping a keen eye on costs this time around. When gold prices last jumped, Australia's gold miners underperformed, falling 16% in the 3 years from 2010, while the price of the metal itself rose 52%. Kate McCutcheon covers Australia's gold miners for Citi.
So last cycle, we definitely saw a lot of transformative M&A, which was very value destructive. So that last cycle from 2000 to 2012, the 10 biggest gold stocks in our coverage universe cumulatively burnt $10 billion in free cash.
As an industry, we made those missteps because when the price did come off and that cycle changed, shareholders went, well, where's the cash? And all the industry said is, well, we reinvested it into projects, or we went and bought assets, and therefore we've reinvested that money for you. And the shareholders were like, well, we would have liked some of that, and we didn't see that. It hasn't changed too much, I mean, other than that we're putting more cash in the bank, which is what our shareholders want to see.
So it's interesting you say you've got more cash in the bank. Has this changed your approach to reserve management and long-term planning as well?
You know, you've got to see it as a sustained price at these levels before, because you can't just change your mine plans overnight. So what it does mean, we look at our reserve pricing, we look at what the costs have changed, because you do see costs generally follow the gold price. And then we look at, well, what projects become more economic in a higher price environment, and then we apply the normal discipline of when do you bring those on.
Look, I think it's important that you look at a lot of these things in hindsight. Some things like hedging, you know, hedge book legacy, at prices that people had never thought that they would, you know, see exposure to. When people had a high equity price, they probably tried to use that currency by raising lots of money on the back of an elevated equity price, and then potentially dropping money out of their balance sheet, return capital to shareholders that then wasn't retained for its own sustainability inside the business. So there are very many different disciplines of what people do at different times.
And do you feel lessons have been learned? Do you feel like the approach is different this time?
I feel that the heat has come out of some of that, but I've found a foundation discipline of true capital management across a variety of things. So, dividend paying gold companies was never really heard of. There's a lot of good track record of gold companies paying dividends, doing share buybacks, compressing registers that they had raised equity on the back of. Those are the type of capital management measures that aren't typical to a gold company.
Even after its recent sell-off, gold is up more than 60% over the past year, a rise that has come in part because the U.S. dollar has gone in the opposite direction. Robin Brooks is a senior fellow at the Brookings Institution and former chief currency strategist at Goldman Sachs. We talked with him before the most recent volatility.
So this move in gold started after Jackson Hole on August 22nd last year. Basically what's going on is there is this fear that fiscal policy, not just in the United States, but heavily in the United States, fiscal policy has been out of control for so long. We are running deficits in non-crisis peaceful times of 5-6% of GDP. We've never really done that before. And so there's a fear in markets that fiscal policy is just out of control. And the only way to get debt to sustainable levels is to print money and to inflate our way out of over-indebtedness. And so my view is that this gold rally is one particular manifestation of really a debt sustainability fear and a fiscal crisis. That is why you're seeing long-term yield all over the world rise. So debt is a global problem. And I think what the gold rally tells you is markets have kind of run out of patience. They're looking for safe havens.
So who's buying the gold? I mean, the price wouldn't go up this high unless you didn't have a lot of people eager to buy, either more buyers, new buyers, or current buyers who are willing to pay more.
So the most common thing I hear is that this is about central banks buying gold. And the story basically goes that the United States and a bunch of other countries put a lot of sanctions on Russia after the Ukraine invasion. And so countries don't want to hold US dollars in their foreign exchange reserves. They're shifting into gold. And it's true that they are buying, but they're buying at a steady pace. The pace hasn't accelerated, so it definitely doesn't explain this crazy run-up in precious metals that we've seen since August. So central banks, I think, are not the explanation. I think, like in every historical bubble, going back to the tulip mania, this is basically about animal spirits and the retail investor and people who are worried about their retirement savings getting eroded by inflation, so seeking safety in things that they think will preserve value.
If it dates back to Jackson Hole last summer, what happened at Jackson Hole that triggered that? I mean, we've had a debt problem in the United States for some time.
Jackson Hole was pivotal because the event, the Fed meeting or the Fed event, where Jay Powell, the chair of the Federal Reserve, gave a speech saying, okay, inflation is kind of high, but the labor market is weak. Yes, those two things are in conflict, but we think the evidence steers us in favor of cutting interest rates. And so that was actually kind of a bold statement because it said, we're going to cut. And in September, 1 month later, the Fed did indeed cut, and it made 3 25 basis point cuts last year. And so it makes sense that that event would raise questions in investors' minds about, hey, how safe is my money in fiat currency? Should I be looking for alternative ways to protect my retirement savings? And so that is why I think Jackson Hole was such a pivotal moment. The other big Fed event that got gold prices and other precious metals to rally was the last cut that the Fed made on December 10th. So Jackson Hole is just one of many Fed events that have caused people to say, hey, wait a minute, why are we easing when inflation is so high? This is steering us in a bad place.
You say inflation is so high. It still has a 2 in front of it. It isn't 2.0, but it's come down a long way. And the 10-year yield, while it's a little higher, right now as we talk, it's around 4.2, something like that. Yeah. If there really is a concern about our repaying our debts in the United States, why aren't the yields higher? Why isn't inflation higher?
So this is a great question. And, you know, let me say, first of all, the debasement trade is totally new, right? We're learning about this in real time. But there are two big pushbacks to the debasement trade. The first is that, hey, wait a minute, U.S. Treasury yields aren't particularly high. If anything, they've kind of traded in a range or even fallen somewhat. So what are you doing talking about a fiscal crisis? And second, if people are worried about inflation as an erosion of retirement savings, then why is break-even inflation still so low? You know, that's pretty low too, as you know. And so I think there's good explanations for both things. First of all, as I mentioned at the outset, there are a lot of places that are in much worse fiscal shape than the United States. So in a relative sense, the U.S. looks relatively okay, and that makes Treasury yields relatively attractive.
So as we look at the political situation today, there doesn't seem to be a lot of prospect of really getting our fiscal house in order and getting the debt down anytime soon. And as far as I can tell, that's true with both parties, Democrat or Republican. So does that indicate, as far as you can see, and we can't predict, but as far as you can see, gold will continue to be elevated and may even go higher?
Yeah, I really worry that we're at the very beginning of this debasement phenomenon. I mean, at the end of the day, this thing has been going on in earnest less than a year. Market phenomena can play out over decades. And I mean, the point that you just made, Treasury yields are still low. Well, there's a lot of reason to think that they can go higher. And of course, we are in an environment where we have midterm elections later on this year. The current administration may do lots of things to stimulate activity. So we may actually get strong growth and we may get a pickup in inflation. All of these things, I think, would steer towards gold and other precious metals going higher. Gold prices also jumped on Liberation Day, April 2nd last year, when there was all this tariff uncertainty. So we need two things. We need governments to focus on getting their fiscal house in order, and we need governments to get along across countries. We need geopolitical stability. Do I think either of those things are likely? No. So I think things have to get worse before they get better, meaning gold goes higher.